Is Carrier Global a buy or a sell? Let's get started with the model. This is a large cap company, 69 billion market cap. They're trading at $77 a share and they have 900 million shares outstanding. Carrier Global provides heating, ventilating, air conditioning, refrigeration, fire, security, and building products. Incorporated in 2019, headquartered in Palm Beach Gardens, Florida. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow peaked in 2023, $2.1 billion. It was cut in half in the trailing 12 months at $939 million. It looks like they were investing a lot into CapEx that year. Net income is the profit or loss on the income statements, revenue minus expenses. And that doubles from 2021 to 2022, cut in half in 2023, then grew 157% into the trailing 12 months, $3.5 billion. That's how you can tell they invested a lot in CapEx. They had high profit, but their free cash flow was a lot lower than the prior year. Revenue is the sales for the company, and that goes up a bit each year from 21 billion to 25 billion. They do pay a 1% dividend, and they can cover that dividend 1.4 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 58 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $51 billion. We divide that by 900 million shares. And we get a calculated stock price of $57. They're trading at $77, so they're trading at a 35% premium. It's a sell according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 67 companies in the same industry as CARR, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the most in CapEx, so what I talked about earlier seems correct. Their debt-to-equity ratio is higher than the median average. For every dollar of equity, 90 cents of debt. They pay a 1% dividend. JCI, Johnson Controls, pays the highest, 1.8%. They generate 900 million of free cash flow. Trane is the highest, 2.9 billion. They rank second in market cap, 69 billion. They're trading at 5 times book value, trading at 20 times earnings, better than the median average. Janus has the best PE at 10. A really rich price to free cash flow, 74. They're trading at 3 times revenue. Fairly close to the average. They generate the most revenue out of any company, including TT, but they're not growing anymore. Their 5-year annual revenue growth rate is 0%. Aspen is number 1 at 26%. Their 52-week high is $82, and the stock is at 77. So they're trading fairly close to their 52-week high. So you might want to wait on this one for it to come down a little bit before picking it up. If you put $10,000 into this company when they started trading and reinvested the dividends, you'd be killing it at $64,000 today. And that, my friends, is a $64,000 question. So to summarize, I have them trading at a 35% premium. This is a really solid company, ranking 7 out of 10. I think it's a bit high right now. So short term, would I buy it? 4 out of 10. Long term, I would definitely buy it, 8 out of 10. Ratios are a bit weak. Price to free cash flow looks terrible, so 4 out of 10. Financials are about average. Revenue is only up 20% since 2021, but free cash flow is down 50% in that same time frame. Let's take a look at their most recent 10Q. Here's their income statement, third quarter of 24, third quarter of 23. Revenue went from 4.9 billion to 6 billion. And they break down their revenue into 2 parts. Product sales, 5.3 billion. Service sales, 700 million. Let's see if they give a further breakdown of the revenue. Of the 6 billion of revenue, 5 billion is HVAC sales, heating, ventilation, and air conditioning. 4.5 billion is product sales, 550 million service sales. 938 million is refrigeration, 800 million refrigeration products, 127 million service. And a little more than half their revenues in the US, 3.2 billion, 1.7 billion in Europe. I know they acquired a big European company. 900 million in APAC, 184 million in other. Their sales went up 21% from last year. Cost of goods sold went up 25%. It went from 3.4 billion to 4.3 billion. So their gross margin went down. Well, it went up 13%, but their margins are less than last year. Gross profit was 1.5 billion, now it's 1.7 billion. Operating expenses, 914 million, less than last year. So their operating expenses went down, even though their revenue went up. So their operating profit improved quite a bit. It went up 50%. Last year, 500 million, now it's 760 million. So even though their gross margins got worse, their operating margins got better. They spent 170 million on taxes, so their net income is 447 million, up from 357 million, up 25%. Let's go back to their full income statement so we could see the shares outstanding. They increased shares from 838 million to 901 million. So they increased shares about 53 million. Let's look at their balance sheet. Current assets 11 billion, current liabilities 10 billion. So their current ratio is above 1. Current ratio is current assets over current liabilities. I put together an Excel model to calculate all the different ratios, including current ratio. Email me if you want a copy. Their total assets 40 billion. The biggest asset is Goodwill, 15 billion. Here's a breakdown of the Goodwill. 14 billion from HVAC acquisitions, 1.1 billion refrigeration acquisitions. And it looks like they added 7.6 billion from an acquisition this year. Footnote 1. It says see note 15. They acquired Viessmann Climate Solutions in January 2024, and they paid 14.2 billion for that acquisition. The purchase price was 11.2 billion in cash, and they added 58 million shares. That's what I showed you earlier on the income statement. That's all the dilution from this acquisition. So they paid 14.2 billion for this company, 11.2 billion in cash, 3 billion in common shares. They issued 58 million shares, which equals $3 billion. Let's go back to the balance sheet. Total liabilities 25 billion. Their biggest liability is long-term debt, 10 billion. Here's a breakdown of the long-term debt. 1.2 billion is due next year at a 2.2% interest rate. 2 billion is due in 2030 at 2.7%, so a pretty low interest rate. They actually owe 12.4 billion of debt. 10.3 billion is due beyond 12 months. 2.1 billion is due within 12 months. I'll show you this on the balance sheet, the 2095. That's right here on the balance sheet, 2095. It's the current portion of long-term debt. Assets minus liabilities equals equity, 15 billion of equity. They bought back 2.4 billion of their own stock. They raised 8.6 billion from selling their business, selling stock, and they profited 9.3 billion from running their business. Retained earnings is the sum of all their prior net incomes minus the sum of the dividends they paid out. Let's look at a statement of cash flows. This is with the trailing 9 months. Operating cash flow starts with net income, and then we adjust for the non-cash items on the income statement. We add back depreciation, 900 million. They actually generated 400 million of cash flow from running their business. Last year was 1.5 billion, so it's gone down a lot. In their investing section, they had a cash outflow of 11 billion. Most of that was from the acquisition we looked at earlier, 10.9 billion. For the acquisition we looked at earlier, they paid 12 billion of cash. But the reason it says negative 11 billion is because they sold some parts of their businesses and they received cash. So this is net, right here, net of cash acquired. In their financing section, they added 2.6 billion of debt. They repaid 4.5 billion of debt. They bought back 400 million of stock. Last year, only 62 million. And they paid out 514 million of dividends. Last year, 465 million. Let's look at Simply Wall Street. Its last price, 77.69 billion market cap, up 0.5% in the past week, up 45% in the past year. The stock started trading in March 2020 around $16 a share. It looks like it's done really well since it started trading. After about a year and a half, it hit close to 60. So if you got it in August 2021, you would have watched the stock go down about 50% over the next year, then back to your cost basis a year after that. So 2 years later, you'd be flat. Assuming you didn't buy the stock in August 2021, you're probably doing pretty well with this stock. It reached its peak in October, just 2 months ago, at 83. In November, it did fall to 70, but it's creeping back up there. Now it's trading between 75 and 80. Simply Wall Street's valuation is 57. They say the stock is 36% undervalued. 20 analysts priced this stock at 82. The free cash flow forecast for 2025 is 2.7 billion by 7 analysts. The 2026 free cash flow estimate is 2.9 billion by 3 analysts. Revenue in 2017 was 18 billion. 3 years later in 2020, still pretty close to 18 billion. Not much growth. Then it started increasing a bit. Now it's up to 25 billion. So pretty moderate revenue growth. They were debt-free in 2017, 18, 19. They started adding some debt in 2020, up to 12 billion. It peaked at 17 billion in the beginning of 2024. Now it's 12 billion. And their equity crisscrosses their debt. Currently, their equity is a little higher at 15 billion. They do hold 2.2 billion of cash, which is plenty to service the debt. The dividend yield in 2020 was 1.2%. The peak was 1.8% in May 2023. The forecast is 1.1% by 2026. The CEO's salary was $800,000 in 2017. Now it's $1.4 million. Total compensation $18 million. Tenure as CEO 5.4 years. In the past year, only insider selling, no buying at all. About 200,000 shares was sold by insiders. 85% of the companies owned by institutions, 8% by the general public, and 7% by private companies. The biggest shareholders at LA firm Capital Research, 26%, then Vanguard, Viessmann, the company they acquired, BlackRock, State Street, JP Morgan, Fisher Asset, Norgus, Fidelity, BNY, T. Rowe Price, Dimensional Fund. Their employee count has gone down from 54,000 in 2018 to 53,000 currently. And the ticker trades on the Mexican Bolsa, New York Stock Exchange, Deutsche Börse, Zitra, Wiener Börse, and Sao Paulo Bolsa. If you want to know how to value a company using a discounted cash flow model, I'll show you in Excel how to do it. I'll even send you a free copy. Click on the video in the top right corner. Thanks for watching.